Guys, in this quick video, we're going to cover exactly what's taking place in the market today. We're going to break down a couple of secrets which should help you trade today fearlessly. Now, with that said, guys, remember one thing. Market bounces are short sellers' hot opportunities. You got to love them. Can't live without them. Here's the situation that we got. Don't get freaked out by the bounce yesterday. Bounces are to be appreciated as they create some phenomenal opportunities to the downside. As a matter of fact, a straight up characteristic of many bear markets is when they drop. Remember this, they don't drop in straight line. They could be dropping consecutively for a couple of days, but ultimately some kind of intraday bounce is expected. Guys, here's the situation that we got developing right now. One of the simplest ways to look at the situation is not to fear the bounces, but rather understand how much more of a bounce can we potentially get and where is your ultimate entry point as far as buying puts. So the condition that we have right now, guys, we've got potentially 20 points of upside and we've got 155 points of downside. Let me think here. Shit, I'll take the puts. I'll buy some damn puts here, okay? I'll start buying them. I'll continue adding them. Here's the situation. Basically, yesterday, the market hits pretty much within a couple of points of our target. Yesterday was 28.51, so we get to 28.55, and then we bounce. Now, this initial drop was caused by non-manufacturing ISM number, and since then, the market reversed and moved higher. Now, many people actually attributed the move higher due to the fact of bad news is actually good news. Now, bad news equals good news has been driving the markets higher over the last 10 years. Basically, it creates opportunity for more stimulus. It creates opportunity for the Fed to cut the rates, all the good stuff. So until a certain point, and in this video, we're going to reveal to you what that point actually is when bad news actually becomes bad news as it actually supposed to be. So looking at the bounce yesterday, you probably freaked out. You're like, oh my God, what the hell is going on here? And clearly, emotions will play games with you guys. Just understand that the worst possible cases, we're getting to a level of 29.25. We're actually pre-market, creating some move 11, so there's already some bearish activity. We may not even get here, okay? The idea is we're likelier to revisit the level of 28.55, hit the 28.11, and finish at 27.50 by next week, as pointed out by one of our videos in the last few days. So understand that you've got potentially 20 points of upside, but the potential downside is all the way down to 27.50 with the crazy day we're about to step into today. I'm recording this about 6 a.m. on October 4th, guys, so things are kind of moving slowly in the expectation of a huge day. There's a lot of things that could be moving the markets today, so we're going to try to break this stuff down for you. The rate we're calculating this level, guys, 29.25. If you followed our channel, there's been plenty of videos posted on this magic level of 29.31. Well, this magic level of 29.31 was the prevalent level in August when basically every time you get to 29.31 right here, just focus on this part of the chart, guys, 29.31, you get here, you drop. So we've identified the first time we've got to 29.31 and said that's the level. Anytime we get here, just basically short the market. So boom, we drop. We bounce back to 29.31, we drop. We bounce back to 29.31, we drop. Do it again, drop. 29.31, drop. So we've done about 6 or 7 times in the month of August until we finally gapped up high and created this huge bearish move 11 formation accompanied by a ton of bearish reversal candles. Ton of spike on the volume side when it comes to institutional selling observed pretty much across the board in various sectors. Now the reason why we're shifting this level from 29.31 to 29.25 because these levels they get readjusted as time proceeds. So now we've been a couple of months into this 29.31 level, and the reason why we're adjusting it to 29.25 is because of this gap down that was recently created on this daily chart in the S&P 500. So basically, anytime we get closer to this 29.25 level, you want to short. You want to short the 2900, 29.10, anything right here in this area. You want to start stair-stepping and buying put contracts because this is what's actually about to take place. Clearly, it's probably hard to see for some of you, but this blue line keeps moving lower I kind of covered it a little bit trying to draw this level here for you, but basically the idea is this blue line keeps shifting lower. The orange line keeps moving slightly in this direction right here, but basically not moving. Ultimately, this will result in a def cross formation, and considering there's just been a lot of support around these levels. Once this support is broken, the 2850 on the way down, which could actually take place today, we could break that level today between 2 and 4 p.m., and I'll tell you why in just a second. So just position yourself to actually start buying some puts in the first part of the day in expectation of a huge reversal lower, and particularly Monday. Some of the key things to consider is trying to figure out this puzzle today, guys, is markets are going through a shift, for a phenomenal shift, guys, of what used to be for many years bad news equals good news, and now we're actually shifting to bad news will actually mean bad news. I know it sounds weird, especially if you're new. You're like, oh, dude, don't. I mean, it's bad news. It's supposed to be bad news in the first. No, it's the market is so twisted that for years it's been taking bad news as good news because it creates a lot of stimulus for the economy, artificial stimulus that is. For the brief purpose of this video, okay, based on the bounce yesterday after hitting our target within a few points of 28.55, right? You may think that bad news is actually good news because basically after we got that bad number, the market spiked. And the reason you may be thinking that is because you've been conditioned to think the old methodology of the last 10 years that bad news is actually good news. Well, it's shifting because if you really take a closer look, what really caused the spike in the bounce yesterday was not the fact that bad news is good news, but the fact that yesterday oil futures reversed. In the last few videos, we shared a ton of oil charts, so I'm not going to do it in this one. But bottom line is just focus on this. As the market hits the lows of 28.55, so does oil at 50.69. After that, the oil reverses. And if you lay over the S&P 500 chart with this chart of oil futures, it's pretty much identical. Every dip in oil, we have not seen this kind of crazy correlation between oil futures and S&P futures, guys, in a long time. So this is something to pay very close attention. Basically, the strategy is very simple. As soon as you see oil futures reverse, because if you review the prior few videos, we've shown you some details on the oil charts. The oil chart is incredibly bearish. As soon as we break that level of 51, we could be at 49. Before we know it, we could be at 42. Ultimately, oil prices are going to 25 bucks. So this level right here, institutional investors, they're still optimistic that they're trying to come in and buy. But as soon as oil reverses and break below that 51 solidly on strong volume, guys, expect some major drops in the market. So as soon as you see oil reverse, okay, if you see oil reverse, because it can just stall out for a day. We think oil will begin reversing maybe about 8, 9, 10 in the morning today. Around 1 o'clock, we're going to get some data on the supply side on oil. So right around 1 p.m. is another critical pivotal point where oil futures could start dropping like a rock, causing some intensity in the selling in the general stock market later in the day today. So basically, as soon as you see oil reverse, begin to buy S&P futures and start buying VIX calls. Now, you know, the strategy is easy. Buy tech puts, all stock puts associated with that. They're pretty easy plays. And guys, if you don't know which individual stocks to trade, hey, just sign up to the 13 Market Moves Daily Analysis. Take our courses so you would know specifically what to trade, when, and how, and stuff like that. Basically, the second part of the puzzle is the job report today. Guys, one thing you should understand about the job numbers is they always manipulated. Manipulated in the sense that they get readjusted later in the future. So the number you really get today is not the real number because it will get readjusted. So when they're doing that, they can really put out any kind of number and readjust it later. I mean, we've seen some readjustments where the job report shows 160,000 jobs and it gets readjusted later, but like, well, no, it was actually 110,000. So this number is not to be trusted. It certainly is a goofy number, the way they do it and the way they readjust it later. So with that said, from the perspective of trading, it's not the number that's important by no means, but rather the reaction of the market to the number. It's all about bid or miss on the number today and the reaction of the market. Just keep that in mind as we're going for this. Now, we already know the answer based on the reaction to the ISM numbers this week, that once we got a couple of bad reports, first on the manufacturing side and then on the non-manufacturing side on ISM, that bad report would actually mean bad news this time, because that's exactly how the market reacted so far this week to bad economic data. So with that, there is a increased probability that the numbers on the report will be manipulated to where the report actually is decent, where there's no crazy surprises, to where, it just kind of things as usual, the economy is good, blah, blah, blah. You'll hear them talk about that. So the initially response, the market could actually move higher, followed by a drop around 10.25. And there's a reason for a 10.25 drop, because that's when some of the Fed chairmen begin to speak. They are going to be speaking between 2 and 4 p.m. a lot today, so expect them to actually indicate further rate cuts. So despite of how the numbers gets manipulated in job report, later in the day, you'll have a lot of them speaking publicly, and they will be indicating further rate cuts. Now, just remember that first rate cut equals market going higher. Second, third, fourth actually equals market going lower, especially when the speed of the rate cuts is noted. That the fastest speed means Fed admits the economy is actually going to hell fast, and it's kind of a move of desperation at this point. So the first rate cut could be just a precautionary type rate cut, but second, third, and fourth, we've seen that time and time before. The crazy situations in the market happened. The most vivid example was the rate cuts prior to the 2007-2008 crash. Fed will have to cut rates based on a poor ISM number, regardless of the job number. Okay, so pay attention to the market drop, which is opposite to the general consensus. So around 10.25, 10.45. We expect the market to begin to drop. 2 to 4 p.m. we expect the market to intensify. Now, contrary to the general consensus, VIX is about to break out higher, not lower. See, one thing to understand about institutional investors is sometimes they think they have everything calculated, and they don't. And that most vivid example recently was in January, February 2018, when the typical trade for institutional investors was to actually short the VIX, basically bet that the VIX would move lower. So when the VIX spiked to 55 in February of 2018, a lot of institutional funds actually got wiped out, some huge funds. So it looks like institutional investors are rather comfy in the zone, thinking that, yeah, Fed will lower the rates, everything is going to be fine, we got stimulus potential going on here again. But it does not necessarily mean that just because that is what's priced in, that is what's actually going to take place. We're going to take the opposite bet, saying the consensus is wrong, and we're actually going to buy VIX calls, expecting the VIX to break out to the 30 level. You can clearly see why there would be placing bets recently against the VIX breaking out high, because we're really close to this level where VIX has failed multiple times. Now, knowing the history of the VIX chart, I can tell you with 99% certainty that VIX is going higher because of this crossover right here. Basically, the blue line crosses the orange line. Anytime you see a setup in the VIX like this, okay, that is preceded by a bullish crossover in the MACD. You have some substantial breakouts. Now, 25 would be the first level, and like 30, 32 would be the next level to target. With that said, expect huge down day on Monday, October the 7th, guys. Let's rock. And if you haven't taken the new course, guys, it is freaking awesome. So do it. Click the links below. Take action so you can become the best trader you can be. Have an awesome trading today on Friday, October the 4th. I'll catch you guys on the next trade soon.
Can't you see that